We're live in three, two, one, action.
All right, guys. The word of the day is this. This should be a good one. Social distancing. This is one of those words that's been pretty popular recently with the whole COVID
Yeah.
19 situation.
When I visit my sister or visit my parents, whether I'm dropping something off for them or buying some groceries for them, then I just say hi through the window, keep my 6 feet distance, like hi.
So don't lose that social touch. You don't need to physically touch that person, a loved one, but make sure you have some sort of social connection. Yeah, I think a lot of people get nervous and get freaked out, but it's also a good chance to kind of like reevaluate your life and what's important. So spend some time with your loved ones at home. This doesn't mean to go out and party, okay? Make sure you're being thoughtful of not just for your family, but the people in our community. So just wanted to say that hope everyone is surviving social distancing. And with all this uncertainty, all this negativity, we wanted to focus more on positivity. We are starting a GoFundMe campaign supporting the Share Our Strength No Kid Hungry campaign. So if you guys want to help us, it would mean a lot to us. We have a link for the GoFundMe. Please click on it, donate what you can. And Annie designed new 6 feet away merch. Starting today to the end of April, April 30th, 100% of the profit is going to be going towards Share Our Strength and the No Kid Hungry campaign. Thank you guys very much for your support, and stay safe, but also don't forget to stay redonkulous.
Thank you.
Yes. Yep. Thank you. Help us feed hungry kids.
All right, let's roll that intro music.
It's the Jeff and Annie and James Redonkulous show.
Hello, guys. It's James here. Welcome to another episode of Econ-Donkulous. I just wanted to have a discussion about the possible 2020 recession, which some say that we are already in the recession. The global economy took a hit when the outbreak started. People got sick. We were not able to manufacture goods. We can't make the goods, so we can't sell the goods. Traveling got restricted. Now we are social distancing. People are staying home, not spending money, and unfortunately, companies are downsizing and laying people off. In hard times like these, people need help more than ever. Help us feed kids in need with nutritious food. Check out our brand new sweater, 6 feet away, social distancing merch. All the profits will go to Share Our Strength nonprofit organization. I just want to say thank you to Jeff and Annie. It was a team effort to make this happen. The merch came out lit, guys. Check it out. The link will be in the description below. So I want to cover the major causes of the 2007-2009 crash, today's possible crash, and compare the two, and also finish it off with how I plan to invest in this recession. So to begin, all recessions are different. I just want to point out the similarities with the 2007 recession and 2020 recession going on today. Before we start, a little background. If you haven't watched the first episode of Econ-Donkulous, we went from an illness that sparked a global recession, which led to massive selling pressure, to liquidity issues in the market, which led to Fed lowering rates during repo, bond yields went negative, and to the stimulus package, which pumped up the market up and made a pretty good recovery. Not all the way, but a good amount. Okay, so let's begin with 2007 to 2009 recession. The United States subprime mortgage crisis was a nationwide financial crisis. It contributed to the recession from December 2007 to June 2009. What triggered the recession was a large decline in home prices after the collapse of the housing bubble, which led to mortgage delinquencies, foreclosures, devaluation of the housing related securities. And then there was also a decline in residential investments and were followed by reductions in household spending and business investment. Um, s- Spending reduction was more impacted in areas with a combination of high household debt and larger home prices declining. The housing bubble before the crisis was financed with mortgage-backed securities. We call it MBS, and also collateralized debt obligations, CDOs. These had attractive risk ratings from rating agencies, and it initially offered better returns for investors than government securities like bonds. There was an increase in home investors, and the ratio of household debt to disposable income rose significantly. So people were earning less and they were spending more in debt. So they had a lot more debt compared to their earnings. So what are mortgage-backed securities, MBSs? MBSs are shares of a home loan sold to investors. So it works like this. A home buyer borrows money from the bank. The bank collects monthly payments on the loan. This loan is then grouped with other home loans. Usually like hundreds and sold to a larger bank that groups these loans into mortgage-backed securities, MBSs. So MBSs are hundreds of loans grouped um, into an MBS. Then the larger bank issues shares of the security called tranches to investors who buy them and collects dividends in the form of monthly mortgage payments. Then these tranches are grouped again and sold as collateralized debt obligations, CDOs. So to put it into simple terms, the bank lent money to unqualified home buyers. Bigger banks sold the MBSs and CDOs to investors. And when the home buyers defaulted on their loans, um, the bubble popped and became a financial crisis. After that crisis, there's now more regulations and policies to prevent that from happening again. So, how does that translate to what's going on today? The global economy is going through a recession due to everything that's going on. The Fed pledged to buy as much government backed debt as needed to help the markets, and also housing and treasury bonds. It also announced that it will buy corporate bonds, including the riskiest investment grade debt for the first time in history. So they're just willing to buy anything and everything to support the market right now. Right now, the unemployment is very high. The Fed cut rates basically to zero. I think it's at like 0.25 right now. And also, the Ford bond rating just got lowered to junk. So this is the first company bond that got lowered to junk. I'm speculating, but I think there's going to be a lot of people that can't pay their home mortgages and their bills, um, and a lot of companies that also can't pay their debt. Um, and the first one was Ford bonds that just got lowered to junk. I think there's going to be a lot more companies bonds that are going to be rated to junk going forward. So we got companies going under. We're going to have home loans going under. This is all just my speculation that I think will happen. So there's some things I'm looking at right now, there's just not enough data right now. The illness is spreading exponentially right now. So I'm looking for the curve to kind of flatten and then go down. There's also hospital workers that do not have enough PPE, personal protective equipment. I'm also looking for unemployment to also flatten and then curve down. And company bond ratings, I'm keeping an eye out on that as well. See how many more company bonds ratings are going to go down into junk. And the Fed said that it'll buy the corporate bonds. So I'm curious how that will play out. I'm not saying that all companies will get lowered, but there might be a good amount of companies' bonds that get lowered because they have poor balance sheets and they're not profitable. And also going to look at how much financial stress in the housing market and the corporate market and the bond market is going to play out, because yeah, there's a lot of debt out there, and there's going to be a lot of companies, people that are not going to be able to pay that debt and eventually go bankrupt or get bailed out by the government. And last thing I'm looking for is company earnings. In April, there's going to be a lot of earnings coming out. It'll show how they did the previous quarter, and they'll also talk about what their outlook is in the future. This is not investment advice. I'm just want to share how I plan to invest in this market. So my plan has not changed yet. I'm still looking for another leg down, meaning another drop down, um, before I start investing. I I I bought some Tesla on the drop, but I sold everything today. There's just too much risk out there, and the charts started to not look good anymore. So I just sold everything and gonna keep an eye out. So let me just show you guys the chart. Okay, so this is a chart of the S&P 500. And let's see. Okay, I don't know if you guys can see it here, but we broke this level. We broke this 2500 level-ish, went all the way down here, and then we went back up into this area above 2500. But it looks like it's kind of flatlining, and it's possible that it'll come back down to this area. So around this area, I plan to buy some of my investments, and then I'm gonna keep an eye out on all the news. And if it still looks bad and it goes down here, this is where I want to go heavy and buy a lot, because that will put us at like 50%. Let me check. It's about 54% from the top. And if we go all the way down here, it'll be about 60%. That'll be a really good deal to start buying stocks. And even around here, around 37, 45% discount, still a good buy. And no one can predict the future. So just gonna keep an eye out, buy some here, and still have some money to buy the rest of my investment here. But if we don't get there, I'll buy it on the way out. All right, guys. So, all right. Thanks for tuning in, everyone. I hope everyone stays safe. Please use social distancing. And also, don't forget to like and subscribe our channel. You can follow us on YouTube, Facebook, Instagram, and our podcast platforms. All the links will be in the description below. See you guys next time.
It's the Redonkulous podcast starring Annie and Jeff and my coolest guy in the world whose name is James. It's Redonkulous.